Let's now look at illustration number 7. Entity B Limited writes an option contract for sale of shares of Target Limited at a fixed price of rupees 100 per share to C Limited. All right, so basically B Limited is writing the option. So Limited is basically the seller or the writer of the option. C Limited is the holder of the option. All right, C Limited is the holder of the option, and Target Limited is the underlying. All right, the underlying is basically the Target Limited. Now, basically, this is actually a call option. This is actually a call option where C Limited has got a right to buy, and the writer, which is B Limited, the seller of the option, which is B Limited, is actually obligated to sell the shares of Target Limited. It may be obligated to actually sell the shares of Target Limited, and the exercise price is basically rupees 100. All right. So, this question is that of a call option where the holder, which is C Limited, will have a right to exercise it, and the writer of the option or the seller of the option, which is B Limited, may be obligated to sell the shares of Target Limited. This option is exercisable anytime for a period of 90 days. All right. The question is saying that this is basically an American option. In an American option, you have the right to exercise it at any time over the next 90 days. In a European option, you're able to exercise it on the maturity. At the end of 90th day, you have the ability to exercise or lapse the option. Whereas in an American option, you have the right to exercise it at any time over the next 90 days. The question is evaluate this under the definition of financial instrument. All right. Basically, the question is asking us to evaluate, is this going to be a derivative or is this not going to be a derivative contract? Now, to evaluate whether this is a derivative or not a derivative, we have to test three conditions. Condition number one is the value of the option contract. The value of this contract should fluctuate or should change based on the change in the underlying variable. All right. As the share price of Target Limited keeps moving up and down, the value of this contract should also keep fluctuating. All right. And we actually saw it via the examples that we did earlier, that as the underlying share price changes, the value of the option contract also changes. The second condition is that the initial investment is supposed to be either zero or negligible. Ideally, given that this is an option contract, there would be an initial investment. Typically, there would be an initial investment which is equal to the amount of premium paid, but the amount of premium is actually a very small component, and therefore that also satisfies the definition of actually being a low initial investment. The third condition is it must be settled at a future date. All right. The option over here is actually exercisable at any point in time over the next 90 days. All right. So the option can be settled at any point in time over the next 90 days, where if C Limited exercises the option, then B will actually be obligated to sell. All right. So C Limited will receive a share of Target Limited, and it will actually pay money to B Limited. It will pay 100 rupees to B Limited. Alternatively, from the viewpoint of B is actually going to deliver shares of Target Limited and will receive 100 rupees from C Limited. All right, so this is going to be settled at a future point in time as well. So all the three conditions are going to get satisfied, and therefore this contract will be regarded as a derivative contract. All right. And in fact, in case of B Limited, where there's a premium receipt that we have, the receipt will actually be recorded as a derivative financial liability. All right. If you're actually receiving any premium, if B Limited is receiving any premium from C Limited, that will be recorded as a derivative financial liability. The journal entry will be bank account debit to derivative financial liability. All right. So any premium that B Limited has collected from C Limited on the initial date will be regarded as a derivative financial liability. All right. We saw why is it a derivative financial liability in our earlier examples. All right. So that is with regards to illustration number 7.